Warren Buffett is not just one of the richest investors in the world, he is one of the most consistent. What makes his success remarkable is not luck, speed, or secret information, but a set of simple, timeless principles that anyone can apply, starting today. In this series, we are breaking down the top 5 Buffett investment principles, not theories, not hype, but real-world rules that have stood the test of time. These principles helped Buffett turn modest beginnings into one of the largest fortunes in history, and more importantly, they can help ordinary investors avoid costly mistakes. Before diving into the individual principles, it's important to understand one thing clearly. Buffett does not invest in stocks, he invests in businesses. This mindset is the foundation of everything that follows. Understanding Buffett's core philosophy. Buffett believes that when you buy a stock, you are buying a piece of a real company, not a lottery ticket. That company has employees, customers, products, competitors, strengths, and weaknesses. If you wouldn't be comfortable owning the entire business, Buffett argues, you shouldn't own even a single share of it. This way of thinking immediately separates long-term investors from short-term speculators. Most people approach the stock market asking questions like, will this stock go up next week? Is this trending right now? What are others buying? Buffett asks very different questions. Is this a great business? Will this company still be strong in 10 or 20 years? Does it generate consistent profits? This shift in mindset alone eliminates many bad investment decisions. Principle number 1. Invest only in what you understand. The first and most important Buffett principle is extremely simple, yet widely ignored. Never invest in a business you don't understand. Buffett calls this staying within your circle of competence. You don't need to understand everything, you only need to understand some things very well. For example, if you understand consumer brands, food companies, or retail, you can analyze those businesses deeply. If you don't understand complex derivatives, speculative crypto projects, or highly leveraged startups, Buffett would advise staying away, no matter how exciting they look. One of Buffett's greatest strengths is not intelligence alone, but discipline. He openly admits that he avoided technology stocks for many years, not because he thought they were bad, but because he didn't understand them well enough at the time. While others chased quick gains during tech booms, Buffett stayed patient. That patience protected him from massive losses when bubbles burst. This principle teaches a powerful lesson. Right finger, you don't lose money by missing opportunities, you lose money by investing in things you don't understand. Why simplicity beats complexity. Many investors believe that complicated strategies equal smarter investing. Buffett completely disagrees. He prefers businesses that are easy to understand, predictable, stable over long periods. Companies like Coca-Cola, insurance businesses, railroads, and consumer brands fit this description perfectly. Their products are simple, demand is consistent, and their business models are proven. Short-term traders often chase complex instruments because they appear sophisticated. Buffett focuses on clarity, not complexity. If a business requires complex assumptions just to justify its future, Buffett walks away. Applying principle number 1 today. This principle is powerful because it is immediately actionable. Ask yourself, do I understand how this company makes money? Can I explain its business model in simple words? Do I know who its customers are and why they buy from it? Can I reasonably predict how this company will perform in 10 years? If the answer is no, the investment doesn't qualify, no matter how attractive the potential gains look. Buffett believes that avoiding mistakes is more important than chasing big wins. Understanding what you own is the first line of defense against emotional decisions and financial losses. The hidden advantage of understanding. When you truly understand a business, you don't panic during short-term price drops. You don't get distracted by headlines. You stay confident during market volatility. This emotional stability is what allows long-term investors to outperform the majority of the market. Most people sell not because the business is failing, but because they never understood it in the first place. Buffett's success comes from clarity, patience, and conviction, qualities that all begin with understanding. Once Warren Buffett understands a business, the next question he asks is far more important than price movements or short-term performance. He asks a simple but powerful question: is this a great business? This leads us directly to Buffett's second core investment principle. Principle number 2. Buy great businesses, not cheap stocks. Many investors make the mistake of focusing only on cheap prices. They search for stocks that look undervalued, ignored, or beaten down, believing that low price alone guarantees future profits. Buffett strongly disagrees with this approach. He believes that a mediocre business bought cheap will always remain a mediocre business, while a great business bought at a fair price can compound wealth for decades. This principle completely changes how investing should be approached. The difference between price and value. One of Buffett's most famous quotes explains this perfectly. Price is what you pay. Value is what you get. The stock market constantly confuses price with value. A stock price can fall due to fear, rumors, or short-term news, even while the underlying business remains strong. On the other hand, a stock price can rise rapidly due to hype, while the business itself is weak. Buffett focuses on intrinsic value, the true worth of a business based on earnings power, competitive strength, long-term growth potential, ability to generate consistent cash flow. If the price is reasonable compared to intrinsic value, Buffett is willing to invest, even if the stock doesn't look cheap on the surface. Why great businesses matter more than bargains. Cheap stocks often come with hidden problems. Declining industries, weak management, poor competitive positioning, inconsistent earnings. Short-term traders may buy these stocks hoping for a quick rebound. Buffett avoids them because time works against weak businesses, not in their favor. Great businesses, on the other hand, have characteristics that allow them to grow stronger over time. Strong brands, loyal customers, pricing power, efficient operations. These qualities allow companies to raise prices, expand margins, and reinvest profits, even during economic downturns. Coca-Cola, a perfect example. When Buffett invested heavily in Coca-Cola in the late 1980s, many critics argued that it wasn't cheap. But Buffett saw something others missed. A globally recognized brand, massive distribution network, repeat customers, simple, predictable business model. Over time, Coca-Cola didn't just grow, it compounded. Dividends increased, earnings expanded, and long-term shareholders were rewarded far beyond what short-term traders could achieve. This investment demonstrates Buffett's belief. Right finger, a great business doesn't need perfect timing, it needs time. Why short-term investors miss this principle? Short-term investors often focus on charts instead of fundamentals. Trade price movements instead of business performance. Exit positions too early due to small gains or minor losses. They may profit occasionally, but they rarely capture the full value creation of a great business. Buffett captures value by owning, not trading. He doesn't ask, "Can I sell this higher next month?" He asks, "Will this business be significantly more valuable in 10 or 20 years?" That single difference in thinking creates an enormous gap in results. Durability over excitement. Buffett prefers boring businesses with durable earnings over exciting businesses with uncertain futures. Why? Because excitement fades, but durability compounds. A business that quietly earns profits year after year, reinvests wisely, and protects its market position will outperform flashy companies that rely on trends, speculation, or rapid expansion. This is why Buffett favors insurance companies, consumer goods, railroads, and utilities, industries that may not dominate headlines, but dominate cash flow. Applying principle number 2 today. You don't need billions of dollars to apply this principle. You need discipline. Before investing, ask, is this business strong or just cheap? Does it have a competitive advantage? Can it grow steadily for the next 10 to 20 years? Would I be comfortable owning this business long-term? If the business is great, paying a fair price is acceptable. If the business is weak, even a cheap price can become expensive over time. Buffett teaches that quality reduces risk, while cheapness alone often hides it. The long-term advantage of quality. Great businesses recover faster from downturns, adapt better to change, generate consistent cash flow, reward patient shareholders. This is why Buffett can hold investments for decades without stress. The business itself does the heavy lifting. Short-term investors work harder, worry more, and often earn less. So far, we have explored the importance of investing only in what you understand and the principle of buying great businesses, not cheap stocks. Now we turn to a third principle that is often overlooked, yet it is arguably the most powerful tool in Buffett's toolkit. Principle number 3, patience and long-term holding. Warren Buffett's entire fortune is built on one simple, yet extraordinary habit, holding investments for the long term. Unlike short-term traders who chase immediate gains, Buffett allows time to compound wealth and magnify the growth of great companies. Time is not just a factor, it is a strategic advantage. While others are stressed about daily price fluctuations, Buffett views market volatility as opportunity, not threat. The power of compounding. Buffett often calls compounding the eighth wonder of the world. The principle is simple in theory, but difficult to execute in practice. If a business earns a steady 10% per year, your initial investment doubles roughly every 7 years. Over 20 or 30 years, that same investment grows exponentially. The secret is consistency over time. Even modest returns, when held for decades, can turn a small investment into enormous wealth. This is why short-term trading often fails. Traders focus on immediate fluctuations. They exit positions too early. They miss years of compounding growth. Buffett's genius is that he does not react to short-term noise, allowing compounding to work its magic uninterrupted. Examples from Buffett's portfolio. Coca-Cola. Purchased in 1988, Buffett held it for decades. Dividends and growth multiplied his initial investment many times over. The short-term ups and downs of the stock never distracted him. American Express faced a crisis in the 1960s, causing a massive stock drop. Most investors panicked and sold. Buffett saw the long-term potential and increased his position, reaping tremendous gains over the next decades. Apple. Even though Buffett initially hesitated to invest in tech, once he understood the business and its competitive advantage, he invested and held patiently, benefiting immensely as the company grew exponentially over a few years. These examples highlight a key Buffett principle: patience converts potential into reality. Why long-term holding works better than trading. Many people assume trading frequently increases profit. In reality, it increases risk. Market timing is nearly impossible to execute consistently. Short-term volatility leads to emotional decisions. Trading fees and taxes reduce net returns. Buffett flips this assumption. He doesn't try to time the market. Instead, he chooses great businesses, analyzes intrinsic value, buys when the price is reasonable, holds patiently through ups and downs. This allows him to avoid unnecessary losses, reduce stress, and focus on compounding returns over decades. Emotional discipline. The hidden edge. Holding for the long term is easy to preach but difficult to execute. Most investors struggle because fear and greed control their actions. Fear. The stock price is falling, maybe I should sell. Greed. The price doubled overnight, maybe I should sell and lock profit. Buffett does the opposite. He buys when others are fearful. He holds when others are greedy. This emotional discipline is what allows him to stay invested even during market turmoil. The advantage of time. Time works differently for investors with patience. It can transform small, consistent earnings into massive wealth. Smooth out short-term volatility. Reveal the true strength of a business. While impatient investors try to make money quickly, Buffett lets time do the heavy lifting, leveraging the power of compounding and the strength of great businesses. Applying principle number 3 today. For everyday investors, this principle can be implemented immediately. Choose businesses you understand and believe in. Ignore daily stock market fluctuations. Focus on long-term growth, not quick wins. Reinvest earnings and dividends. Trust that time will reward good decisions. Even a small investment, if held and compounded over decades, can surpass aggressive short-term strategies in returns and reduce stress. Long-term versus short-term thinking. Consider the contrast. Short-term trader buys a stock, monitors minute-by-minute price changes, sells after small gains, often missing bigger opportunities. Buffett investor buys a great company, ignores short-term swings, reinvests dividends, and benefits from decades of growth. The difference is staggering. Short-term thinking may feel exciting, but long-term investing consistently outperforms over time. The takeaway: patience and long-term holding are not passive strategies. They require conviction, emotional discipline, and trust in your analysis. Buffett's entire philosophy proves that the stock market is a device for transferring money from the impatient to the patient. This principle also serves as the bridge to the next one: understanding how to identify undervalued opportunities and maximize returns by buying wisely and holding confidently. So far, we have explored 3 of Buffett's most important principles. Invest only in what you understand. Buy great businesses, not cheap stocks. Patience and long-term holding. Now, we move to the final 2 principles that complete the core of Buffett's investment philosophy. These last principles explain how to evaluate opportunities, manage risk, and apply these lessons for consistent wealth creation. Principle number 4. Focus on the business, not the market. Buffett repeatedly emphasizes that the stock market is not a short-term scoreboard, it is a mechanism for buying and selling ownership in businesses. Most investors focus on daily market news, Stock price fluctuations. Hot tips from social media. Buffett focuses on business fundamentals, competitive advantage, cash flow, long-term growth potential. He often says, in the short run, the market is a voting machine, but in the long run, it is a weighing machine. This means that while stock prices may swing wildly due to speculation, the true value of a company will eventually reveal itself. Why market obsession is dangerous. Short-term traders get caught in market noise. Selling in panic during a drop. Buying blindly during hype. Chasing fads and trends. Buffett avoids all of this. By ignoring market hysteria, he reduces emotional errors and focuses on the long-term story of the business. This principle is especially relevant today, with news and social media influencing investor behavior constantly. By sticking to fundamentals, investors can make rational decisions rather than impulsive ones. Principle number 5. Margin of safety. Buffett's fifth principle is arguably the most crucial for protecting wealth: always invest with a margin of safety. This concept, popularized by his mentor Benjamin Graham, means buy at a price below intrinsic value. Protect yourself from unexpected market downturns or business risks. Even if a company is excellent, mistakes in valuation or unforeseen events can happen. A margin of safety ensures that your investment can withstand mistakes or volatility without catastrophic losses. For example, if intrinsic value is $100 per share, buying at $80 provides a buffer. If the business underperforms slightly, the impact on your capital is minimized. Buffett combines this principle with patience. He waits for opportunities where quality businesses can be bought at a reasonable price, ensuring that compounding works in his favor without unnecessary risk. Putting it all together. Real-world examples. Coca-Cola. Strong competitive advantage, brand and distribution. Purchased at a reasonable valuation. Held for decades, dividends reinvested. Apple. Strong moat through ecosystem and brand loyalty. Bought at fair price, patience rewarded exponentially. BNSF Railway. Purchased during the 2009 financial crisis. Stable business model, strong cash flow. Buffett's patience and margin of safety ensured long-term gain. All of these examples combine the principles: understanding, quality, patience, focus on business fundamentals, and margin of safety. The psychological edge. Buffett's principles are not just financial, they are deeply psychological. He manages his own emotions and leverages them to his advantage. Fear becomes opportunity. Patience becomes power. Discipline becomes consistent growth. Most investors fail not because of lack of knowledge, but because they react emotionally to short-term swings. Buffett's principles provide a framework to stay rational even when the market is chaotic. Applying all 5 principles today, let's summarize actionable steps for any investor. Invest only in businesses you understand. Choose great businesses, not cheap stocks. Be patient. Let time and compounding do the work. Focus on the business fundamentals, not stock price or market noise. Always maintain a margin of safety to protect your capital. By consistently applying these principles, you reduce risk, you maximize long-term returns, you avoid emotional mistakes, you allow the power of compounding to work. Final thoughts. Warren Buffett's investment strategy may seem simple, but simplicity is deceptive. Following it requires discipline, emotional control, deep understanding, patience. Short-term thinking may feel exciting, but history proves that patient, principled investors consistently outperform. As Buffett famously says, the stock market is a device for transferring money from the impatient to the patient. By applying these 5 principles today, anyone can think and invest like Buffett. The key is action and consistency. Start small, focus on what you understand, buy quality businesses, hold them, and give time the chance to multiply your wealth. Remember, Buffett didn't become rich overnight, and neither will you, but by following these timeless principles, you can build sustainable, long-term wealth far beyond what short-term speculation could ever achieve.